the bars being exported to China are 400-ounce bars, which are typically the type of bars used by central banks. So there was that. And the second thing that I came across, which, again, it's secondhand information, is there's an awful lot of gold being mined in China. I think it's something like 20% of the world's annual gold supply being mined in China. And there's heavy export restrictions on gold from China. And the question mark is, where is all that gold going? Is China secretly acquiring gold through the back door by buying up some of its own gold production?
Well, I agree with that. I think that's what a lot of the analysts that say China has over, officially over 30,000 tons, and that's what they've been saying. China now is the biggest gold producer. So yeah, I think the rest of the world, people that don't follow gold like we do, they think, oh, the U.S. has over 8,000 tons, China only has 2,000. The U.S. is top dog, but I think it's the reverse. Actually, I don't think the U.S. has as much as they say. They would have done an audit already, and China has a lot more. And I'm not defending China. I'm just looking at the facts, and I think that's bearish for the dollar.
The quiet reshaping of the global gold and silver landscape is accelerating beneath the surface, driven by flows, restrictions, and accumulation patterns that point to a profound structural shift. Large institutional bars, tightening export controls, and discrepancies between official reserve numbers and real-world movements are forming a clearer picture of a changing monetary order. Gold is leaving Western vaults in central bank-grade form, while Asia continues to absorb it at a pace that suggests strategic accumulation rather than cyclical buying. At the same time, China and India benefit from a steady stream of metal that increasingly bypasses Western price centers, raising significant questions about long-term availability. Marioinnecco, a longtime macro observer, and Clive Thompson, an experienced precious metals analyst, highlight how China's production dominance, restrictive export rules, and opaque reserve reporting paint a very different picture of global gold distribution than official numbers suggest. With China mining roughly 20% of the world's annual supply and imposing tight controls on outbound flows, the likelihood of off-balance sheet accumulation rises. Customs data showing rising shipments of 400-ounce central bank bars into China only reinforces this view. Silver appears to be following a similar path. China's new licensing system places silver alongside rare earth metals, signaling its elevation to a strategic resource rather than a simple industrial commodity. In a world breaking into competing geopolitical blocks, these moves point toward a future where physical metal, not paper claims, defines real pricing power. Now, we present the clips from their interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
About gold, China's secretive gold purchases help fuel record rally. And this is not like the research we've seen from people like Alistair McLeod and others that say that China has over 30,000 tons. This is just this year. Apparently, I think it's Jan Neuenhaus. He's been looking at the customs number between the UK and China, and they've increased a lot. And
I tried to investigate this, Mario. It's very difficult to get hold of the data, but from what I can find, first of all, exports of 400 kilo bars. This is second-hand information, not original research. You can find that data on the HMRC trade website, where though I couldn't find it, but and also from Switzerland to trade statistics with China. So the export of 400 kilo bars to China are quite a high level, and they're saying that these bars can't be destined to retail use because China, on the Shanghai Stock Exchange, it's on the Shanghai Gold Exchange, it's 1 kilo, 3 kilo, and 10 kilo bars, I think they said, whereas the bars being exported to China are 400-ounce bars, which are typically the type of bars used by central banks. So there was that. And the second thing that I came across, which, again, it's secondhand information, is there's an awful lot of gold being mined in China. I think it's something like 20% of the world's annual gold supply being mined in China. And there's heavy export restrictions on gold from China. And the question mark is, where is all that gold going? Is China secretly acquiring gold through the back door by buying up some of its own gold production?
Well, I agree with that. I think that's what a lot of the analysts that say China has over, officially over 30,000 tons, and that's what they've been saying. China now is the biggest gold producer. So, yeah, I think, the rest of the world, people that don't follow gold like we do, they think, oh, the US has over 8,000 tons. China only has 2,000. The US is, top dog, but I think it's the reverse, actually. I don't think the US has as much as they say. They would have done an audit already, and China has a lot more. And I'm not defending China. I'm just looking at the facts. And I think that's bearish for the dollar.
The numbers which I came up with from various sources all add up to China having 7,000 tons of gold, which is about 3 times the officially announced reserves. And that comes from 25% of domestic production going into the China vaults, the net withdrawals from the Shanghai Stock Exchange, which is not going to the public at large, the subtracting the total consumption in China, which is 24,000 tons of private holdings going to jewelry. But I added all the numbers up and I came to a figure of 7,000 tons would be their current holdings compared with the 2,300 they claim. But one significant point to perhaps add fuel to the fire is the fact that China's foreign exchange reserves, the official reserves that they declare every month, have been broadly static since 2014. They plateaued, so they're going up and up every year after year. Their trade was going up. They had this huge surplus every year, so the reserves were going up every year until 2014. And yet they appeared to plateau, according to the official numbers in 2014, yet the trade and the surplus, the Chinese surplus, keeps going up year after year after year. So the question is, how come they're saying their reserves are not really increasing, yet they've still got a growing economy, growing trade surplus? Where's it all going? Well, it could be going into gold. We don't know, or maybe they're throwing it away. I don't know. The gold and silver effectively being sent to China and India. Well, we know that the LBMA are sending out from the customs statistics, and that's not me seeing it firsthand, but reading this Jan Neuenberger, the one you mentioned earlier, Jan. We know that he's read the customs statistics, and there's a lot of 400-ounce bars going out in the direction of China. Not sure about India. I don't know.
Latest update. Swiss expert on precious metals. China has pulled the trigger on silver. In China, you can only trade gold and silver futures if the metal is physically deposited. And it says this past Friday, the Chinese said no more deliveries. We're keeping our metal. I'm not too sure that's 100% right, because I was looking here. They have put some limits on things, but it's not 100%. Let me see here. Yeah, here it says China has not completely shut down silver export, but has implemented stricter export licensing rules for 2026-2027, adding it to a list of tightly controlled materials like rare earths. So yeah, I agree with that. I think, don't know if you guys remember that Zoltan Pozsar, a few years, I think 3 years ago, he said that commodities are going to become a lot more important. Yeah, commodity nationalism. And I think it will, because the world is fracturing. Globalization is kind of splitting into blocks. So yeah, and I don't think the LBMA will be able to keep just trading paper. People eventually will want the physical silver.
I was just going to say, so silver's not banned from being exported from China, but it's got into the same category as rare metals, i.e. you need an export license to export it, which it kind of makes it slower. So it makes it slower and more difficult to get silver out of China if you need it.
The widening stress inside global money markets is becoming more visible as liquidity fractures deepen and trust between institutions weakens. Rising repo rates, growing reliance on emergency Fed facilities, and persistent fears of hidden balance sheet fragility all point to a system struggling to function without intervention. Historical parallels to past monetary breakdowns, especially those seen during the collapse of the German mark, underscore how quickly confidence can erode once debt levels outstrip the capacity of governments to stabilize them, as interest obligations climb toward unsustainable levels and money creation becomes the only backstop. The long-term trajectory points toward currency debasement rather than restoration. These same pressures amplify the appeal of hard assets. When quantitative easing returns as a permanent feature, liquidity will flow into anything resistant to dilution. Once the shift becomes clear, capital typically rushes, bypassing cash in favor of tangible stores of value. Let's get back to the interview.
I think the rate that's been going up is the normal repo market, not the Fed standing facility, and that's why these institutions are using the Fed, because the Fed can lend it to them, I think, at a lower rate. Is that it, Clive? Is that the way you see it?
Yeah, I mean, the whole point of the repo market is when a bank needs liquidity in a hurry, it can deposit with the central bank its treasuries and get in return some cash. But when banks do too much of that, that can be seen by other banks who can observe it. That can be seen as a sign of distress or worry. So I don't know. I don't quite know what the problem is here. The fact that interest rates on these repos might be a little bit higher, is that indicating that someone is wanting to borrow money from the Fed and can't get it, or I can't quite get what the problem is?
Yeah, I think though, I think it's because the repo market usually doesn't involve really the Fed. It's financial institutions bringing, let's say, a hedge fund coming to J.P. Morgan and saying, "Here's 10 million treasuries. Can I borrow?" That's what it is.
Oh, okay. So it's not the Fed at all
Yeah,
setting
so
the
the
rates.
Fed
Okay.
has stepped in because the private repo market is kind of people are losing confidence in each other, but and that's what happened in 2019. But someone's asking here, Dutch libertarian, when hyperinflation or debt default? I personally think that there won't be that default, because that's, well, at least in the US, because they can, like Alan Greenspan said years ago, he was sitting next to Austin Goolsbee, who is now, I think, Chicago Fed president. He said, well, you can always print. We will never default. And Austin Goolsbee looked at him like this on TV. I've touched upon this a few times, this chart. So on the left, it's the chart of the one gold mark in paper marks. And to me, this chart looks really similar to the one that's evolving right now. And of course, this ended in hyperinflation in Germany in 1923. And I think it started in the summer of 22 is when it broke above this line. And by the end of 23, like you said, no one wanted to part with their gold, for like I don't know, 1 trillion or 1 quadrillion marks. It's ridiculous. But of course, this chart here on the right it's a bigger fractal, but it looks very similar. And we started, I guess, we took off March, I think, or spring of 2024. So it might take a few more years, because this one here is this is over a shorter period of time. So it took a year and a half. So this could take maybe a little longer. So Clive, what's your view on deflation, debt collapse, or hyperinflation? Even though, like Rafi said, at the end of the day, both are the same. You're going to destroy the currency no matter, even if you have debt deflation as well, because debt is the other side of debt is the currency.
Well, the path we're on seems to be unstoppable. I suppose the real question is what precipitates a sudden rush to get away from cash and into anything else. And you never know what events are around the corner. It could be some war or civil unrest or some geographic event. The world is full of surprises. Black swans, we call them. A black swan is something which does happen, but the world is not expecting to happen. It's one of those very, very rare events which are supposed to happen once every 10,000 or 100,000 years. But of course, there's so many events which can happen. Sooner or later, something does happen. And over the last 50 years, when I've been investing, we've seen a fair smattering of black swans here and there, things which were never supposed to happen. So I think it's only a question of time before we do have some major cataclysmic event which will make people run for cash. And, one of the likelihoods of that is the fact that the interest on the US government debt is climbing very, very fast. It's climbing as a percentage of their tax take. So we're currently at 18%. The Congressional Budget Office says we're going to get to 22% in a couple of years. That's 22% of everything they collect in taxes will go to service the national debt. And that's just a couple of years away. Stretch that out to the 2030s, and we could be in a situation where the interest payments on the national debt are close to or even potentially exceeding the totality of the tax take. And then you're in a situation where it's spiraling out of control very, very fast. I don't think we'll get to that situation, because I think sooner or later, before we get to that, people are going to panic and say, why am I lending to a government which can never repay? And of course, it's not just the US government, it's all G7, all the Western governments are spending way beyond their means. I mean, I think we're getting closer to the printing of cash in the USA now. John Williams, who's the deputy chairman of the Federal Reserve, next in line to Alan Greenspan, and also the New York Federal Reserve president, said about I think it was 4 or 5 days ago that they're very close to buying bonds again. That's quantitative easing. So when they buy bonds, they basically print money, that's the liability side, to buy the government bonds, that's the asset side. But basically, that's putting money into the system. And the reason they'd want to do that is to provide, to keep he said, to keep short-term interest rates down. But actually, the reality is here, it's yield curve control to keep the longer-term interest rates down so that the government can continue to borrow money without the interest rates spiraling out of control. But the consequence, of course, of that is there is more money in the system, and of course that money has to find its way into assets. So the day they start doing that will be very bullish for gold.
I think it's all those factors. The fact that they are starting it again, that means the balance sheet is going to increase, and the amount that they're going to announce will be very important, and how long they do it for. I think they're going to do it until the system implodes. And why do I say that? Well, because if you look at history, especially like in revolutionary France, when they started printing the assignats, they were very reticent about printing, because they knew from the Mississippi bubble back in the 1720s that it ends in tears. So they said, we're just going to do one issue, kickstart the economy. Sounds very Keynesian, doesn't it? Kickstart the economy. And they did to some extent, but then the effect goes down again, and they kept printing, and it ended like with people rioting in Paris and burning the printing press. So I don't think they're going to be able to stop this QE. Or Clive?
I would say the day they do it is the day that gold explodes upwards. In answer to Chris Conman's question, the minute they do it, they've demonstrated that everything has changed from the quantitative tightening of trying to control the economy by limiting the money supply into an economy where they're letting it expand freely. And of course, once you start, there's no stopping it.
But one thing back in 2013, that era, was that investors still had confidence that the Fed would be able to stop QE and go back to the pre-crisis level, which was around 800 billion in its balance sheet. I even remember Ron Paul asking Ben Bernanke, and he said, it won't be a problem. And what's her name? Janet Yellen once said doing QT and unwinding the balance sheet is going to be like watching paint dry. So I think by now people will have lost confidence, and they will realize, and it could be that trigger, Clive, where people realize that it will never stop, and they will want anything but paper. They will want hard assets, gold and silver. That's the way I see it.
Absolutely. I mean, and I think if we do go into this hyperinflationary spiral, And I mean, I don't think it's going to get that far. I think long before we get to that, there'll be all kinds of capital controls and restrictions of what you can do with your money, kind of basically saying you can only spend, probably they'll say something like this, you can only spend digital dollars or only spend the CBDCs. And then there's a limitation as to how much you can put into your digital dollars or how much you can transfer from your bank to the CBDC. And through that sort of control, they'll try and control the, inverted commas, wicked speculators who are betting against the currency.
The growing instability within the global financial system is becoming harder to ignore as liquidity stress spreads through the core of debt markets, rising repo rates, declining trust between major institutions, and the increasing dependence on central bank support point to a structure that is quietly losing balance. The pressure comes from multiple directions: surging government interest costs, declining confidence in long-term repayment, and the revival of bond-buying programs aimed at keeping borrowing costs low. These conditions often accelerate the shift away from paper assets and toward alternatives that can't be manufactured at will. It aligns with the pattern seen in past monetary breakdowns, where sudden policy pivots reveal how fragile the underlying system had become long before the public became aware of it. If quantitative easing resumes on a large scale while inflation remains elevated, capital tends to shift urgently into scarce, tangible assets. The psychology changes quickly once investors recognize that dilution is no longer a temporary phenomenon. At that stage, preservation becomes the priority, and defensive positioning replaces speculative optimism. Share your thoughts on their analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.